If you've been curious about what a credit score means, how to manipulate it, and how to get the best credit score possible, this video is for you. Hey guys, welcome back to another video. Today we're talking all about credit scores and more importantly, how you can manipulate your credit score to get the best one possible. Why is a credit score important, or even a credit report? This is super important for so many different reasons. Employers, if you're working at a bank or financial institution, they want to see that you have a responsible credit history. If it's a very competitive market and it comes down to two people equally qualified, but one has a good credit score, they're probably going to go with that person. So it can actually hurt you from an employment standpoint. Insurance companies, they want to see that you're creditworthy as well. They're looking at your score, they're looking at your report when they are creating your premiums, the amount that you're actually going to be paying per month, every 6 months, or per year. They're looking at your credit score as well to see how responsible you are. Of course, we know lenders, anytime you go to get a house loan, a car loan, which I don't recommend, but if you do, those things are all factors as well. So they're also looking at your credit report. And I have seen so many people get denied on the spot for a house loan for their dream home because their credit was garbage. Or if they do give you a loan for, like, say, a car loan, they'll give you the loan, but the interest rate will be anywhere between 12 and 19% interest. It's ridiculous. It's super, super high. So not worth it, because credit is important. As much as I hate it, and as much as I like to say you don't need credit, it's important, guys. It really is. So it's important that you understand what your credit score is composed of. So let's dive into the 5 factors that make up your credit score, and then we'll talk about some common myths and how you can boost yours as responsibly as possible without taking out debt. The first piece that is really critical to your entire credit report is your payment history. Your payment history is 35% of your credit score. 35%, it's a ton. What they're looking for is how often do you make on-time payments? Have you ever made a late payment? Have you ever missed a payment? That's what they're looking for when it comes to payment history. That entire picture of how responsible you are with paying your bills on time. Now, when I say bills, I mean bills that are reported to your credit. Your utility bills, if you pay that late, that's not going to be reflective on your credit report. But things like a credit card payment, a house loan, a car loan, a student loan, those kinds of things that are actually debt will be reflective on your credit report if it's a late payment. Now, if you have one late payment, call the company and see if they will waive that. Most of the time they will, so that that doesn't hurt you longer term. Just a little tip there. The next factor, which is a big one, is called utilization. So utilization makes up 30% of your credit score. It's a big deal. With utilization, what that actually means is if you have a credit card with a limit of, say, $1,000, and you have another credit card with another limit of $2,000, your total capacity to borrow is $3,000, assuming you only have those 2 cards. So your capacity is $3,000. Your utilization is the amount of that $3,000 that you were actually using. How much have you charged? So when you're looking at utilization, it's really calculated on a per card basis, an individual, and then an overall. So when you're looking at utilization, you want to be between 0% and 10% to be optimal. You can go up to 30%. That's okay. After you hit 50%, it will drastically negatively impact your credit score. So I personally tested this recently when I booked a bunch of flights to Peru. So I put it on my credit card, and that put me over 30% utilization. The interesting thing is, the next month when that balance was reported on my card, remember, I pay off my cards on time and in full every single month, but sometimes the statement balance will still be reflective of that. When my balance was reported, my credit score dropped by about 10, I think it was 10 or 15 points, I don't recall for sure, but it did drop from going over 30% utilization. So if you want to be responsible, 0 to 10% is ideal. Yes, that means if you have a $1,000 card, you should never put more than $100 on that credit card. That's what that means if you want to boost your credit score as optimally and responsibly as possible. It is kind of weird, right? You're like, why would they give you all that credit limit if they don't want you to use it? I know, but it's, from their eyes, it's a responsible way to approach credit. The next factor that impacts your credit score is the credit mix. This is about 10% of your credit score. And what this means is the credit mix is the different types of loans. Do you have revolving debt? Do you have installment type debt? So if you have a mix of debt, that is about 10% of your score. So credit cards, house loans, student loans, car loan. Now, we'll talk about what each of those means later. That does not mean that you have to take out debt in order to boost your credit score. I do not want you to think that. So we'll talk about how to manage that responsibly, but that is 10% of your score. The next piece of your score is the length of history. This accounts for 15% of your entire credit score. And basically, it's a simple thing. How long have your accounts been open? That's what they're looking at, which is why typically when people say they're gonna pay off a credit card and close that account and get rid of it completely, not the best idea because you lose all of that credit history. Now, if the account goes inactive, that's okay because it's still shown on your credit report as a capacity. It's still a credit limit that you can use if you just called and reactivated that card. So having the card deactivated does not hurt you. It sometimes will disappear from your credit report depending on how the company reports. But in general, if you pay off a card, you do not want to close it, especially if it's one that you've had for a long time and builds up your usage. Now, there are certain circumstances when you would want to close a card. Maybe the yearly fees associated with that are way too high, or you just feel like you cannot really responsibly manage credit and that scares you. That's okay. That totally makes sense. But do know if you do that, your credit score will take a dip. Okay, so the last 10% of your entire credit score is the hard inquiries. Now, this is stuff that we all kind of know. 10% of your score is based off of when you have somebody pull your credit score. So a lender. So for example, if you're going to get a house loan and they are running through your application, they're gonna pull your credit score to see, can we actually lend this person money? Are they credit worthy? So they're gonna pull your credit score. When a third party or somebody other than you pulls your credit score, that temporarily dings your account. We hear that term all the time. It will basically drop your credit score just a tiny bit temporarily for about 3 to 6 months. If you're doing this all the time and you're constantly applying for different loans, to the credit bureaus and to the reports, it looks as if you're being a little bit irresponsible. Like, why is this person trying to get so many loans in such a short period of time? That seems a little weird. That's why that would start to hurt you in a negative way. And that's the reasoning kind of behind that. Just to be very, very clear, when you personally pull your credit report and you're looking at your report, that does not hurt your credit score. You can do that 100% for free at annualcreditreport.com, or you can use something like Credit Sesame or Credit Karma to get your credit score and a mini version of your report. So that's where you can go to get your credit report and your credit score. Also, if somebody did pull a loan for you, they looked at your credit report, you are legally enabled to have a copy of that report. So don't forget to ask for a copy if you applied for a loan, like immediately, like last week or so. They will give you a copy of your credit report. And most banks will do that for you too. So if you just go into your bank or your local credit union and just ask for a copy of your report, they'll pull that for you too. Okay, so let's talk about what this stuff actually means. So your credit score, the highest it can be is 850 points. You're considered to have good credit if you're anywhere between 750 and up. So 750 and higher is pretty great credit. 720 and higher is doing pretty good too. So anywhere in the 700s, you're doing all right. Anything below that, room for improvement. We need to build that up a little bit more. But sometimes the difference between 10 points may not seem like a lot until you go to get a house loan, and that one little difference is the difference between an extra 1% on your house loan and an extra 2%. Sometimes that can really play a big factor of getting the best rates on your home loan. It can cost a lot. And while 1% or even 0.5% doesn't sound like much, on a house loan, with the way that the interest is charged and amortized, it adds up to seriously about $100,000 sometimes. So it can be a big, big decision just because you didn't learn how to manage your credit properly.